Hey, what's going on? My name is Ben, and normally when I come out with these videos, you guys may know some of the videos I come out with. Generally speaking, I'm warning you guys that the market's going to fall. I'm warning you guys about coming volatility. I'm warning you guys about, an impending market crash, something very doomsayery. And I'm not telling you to just panic and sell absolutely, but at least to go long volatility, or to, short for a temporary period of time, the S&P. And as you may or may not be aware, that's with a 100% accuracy. However, things are different this time. I'm actually not going to be bearish. A lot of people are saying that the market is going to just collapse from here. I think it's certainly possible a pullback is coming. Certainly possible, but for like the first time ever, I'm gonna step onto the idiot side of things here and just the devil's advocate and present a case for you why I think the stock market may continue to keep rising. Now, I realize you're like, what are you fucking smoking? What are you smoking? Bath salts here? But I feel that a pullback may occur, all right, but I don't necessarily believe that it's going to be substantial. And if it is substantial, I don't believe it's going to lead to something like a 20% market correction or a 40% market correction, as a lot of people seem to be suddenly within the last 48 hours advocating or saying is going to happen. A lot of people all of a sudden are like, a market crash is coming, here it comes, and motherfuckers are going like, 40% market crash, here it comes. Well, I'm just going to present the other side of it. Okay? Now, I'm going to start off by showing you a chart. In other videos where I tried to make this, I started off with some information first, okay? But I'm going to show you the chart, and so I'm going to show you the logic process that I went through trying to find this, and you may find that quite interesting. So first and foremost, I'm going to show you this picture. It was posted by Zero Hedge, and it is the New York Stock Exchange Investor Credit in the market. And so what we're going to be looking at is credit balance, and I'm going to read credit balance to you really quickly here. Investopedia explains credit balance. In the case of a short sale, an investor essentially borrows equity shares from his or her brokerage and then sells the shares on the open market, hoping to buy them back at a lower price and a later date, and then return them to the brokerage, pocketing the excess cash that's left over. When the shares are first sold, the investor receives the cash amount from the sale in his or her margin account. This amount plus the specified margin amount, which must be deposited by the investor under Reg T, comprises the credit balance. I'm sorry, we're going to go see a movie. We're going to go see Grandpa. I'm getting shit-faced drunk, and we're going to go see that jackass Grandpa movie, because fuck it. You know what? If we're watching Honey Boo Boo, I'm fucking drunk as hell. It must be maintained in the investor's margin account as a form of assurance that the shares can be repurchased from the market and returned to the brokerage house. Now, I'm just going to try and surmise what I believe that says. Essentially, this is only talking about short sales, okay? And this is talking about the amount of money which people have as a positive and negative balance, okay? So, if the market is rising, we're talking about short sales here, people are going to have a negative balance. So the higher the market rises, the more people who are shorting the equity markets or the stock market, right, are going to lose money. Now, if the market begins falling, okay, they're going to have a positive balance because they're shorting the market, and as the market falls, they make money. So we're going to pop over here and take a look at this Zero Hedge post right here. And I want you guys just to take a quick look, okay? Oh, take a detailed look. You got to pause the video, do it. And I'm gonna actually hold this dead still so you guys can get a nice clear image. I'm sorry, my hands kind of shake a little bit. Apparently it doesn't want to like get its shit together. There we go, now it focused. So, what you're looking at is, in blue, the S&P 500. In red, you're looking at the negative credit balance, and in green, you're looking at the positive credit balance. Now, as you can see, what I'm going to do is zoom in here, and I'm going to show you, if you'll notice, with my mouse here, in this time period here, we're about mid 2000, and I'm going to show you really quickly here that this here is mid 2000, and this begins pushing in quite hard. Now, once again, all of these are 1 month delayed, so you got to remember that whenever you're seeing each one of these months being reported, it is a month delayed, but nevertheless, quite a good indication. You can see there's a hefty pullback here, a very hefty pullback, right? Now, when was the last time there was a hefty pullback, okay? That was here in 1997. This was about the same time that the credit markets began experiencing some volatility. And this was about, I believe, I want to say about the same time that long-term capital management, a lot of people know LCTM, began suffering a hell of a lot of problems and began blowing up. And that is here in 96, 97, right about there, and here 98. And so we begin to see the first episodes of credit crunch going on here in 97 and 98. And we see the first major market pullback here in 98. Now, as this continues going on, the market continues rising, and we get our first major pullback here. And a lot of the people shorting the market begin, if I may quite frankly say, making a killing. And the negative margin begins plummeting. So if you go look at the S&P 500, right? That's not much of a pullback, right? It's pretty mild pullback. But a lot of people went very short right at the top. And so the positive balance began screaming, well, this is the negative balance, but since it's an average, a few people out there began making a boatload of money really frickin' quickly. Now, after this, it begins skyrocketing upward, which means that somebody shorted the top of this market with, an amount of force that cannot really begin to be described. Someone shorted the market with a lot of force. And as the market began pulling back, you can see the S&P here doesn't really pull back that much. I mean, we're only a small, well, not a small pullback, but we have, a moderate pullback compared to the entire complete plummet of the S&P. And just on this pullback here alone, and you can see we're pushing into 2001, we've gone from having a massive negative balance here to an entirely positive balance, right? So apparently people shorting the market here, right, somebody comes in and shorts the living shit out of this market and starts killing it, and it kind of averages out that the negative balance just screams back inward, and as soon as it moves to a $0 balance here, man, oh man, does it really just begin to plunge afterwards. I mean, the S&P just keeps going down as soon as it hits this moment, right? So we're going to keep going along this timeline here. Then look, the negative balance begins going down again, and miraculously enough, the market's rising. But here, mid 2006, we have the most minor looking pullback, right? What happens? Something very interesting happens. This negative balance begins moving back towards zero. So we're almost at an average positive balance, right? That's certainly very interesting, isn't it? What did that, right? I mean, look at all these other pullbacks. They're average. There's nothing special about them, right? So why does this pull back? I mean, if we're using this here to gauge, right, when it's time to short the market, like for instance right here, we're screaming back in after this really big plunge, and you short the market and you make a killing, right? All right. Over here, what about this? You short the market here, huh? And you don't make a killing. You get slaughtered, in fact. So what went wrong, right? Well, let's keep looking through. Here in 2008, okay, we can see that the S&P topped out right here in about 2007, in really late 2007. So what began happening to the negative balance? As early as, what appears to be May, April. Oh, whoops, my bad about that. May, April. Yeah. As early as May, April, we begin seeing a pullback, which means you would know about it by June, July. And that is, plenty of time to short the market, right? Plenty of time. You're going to catch the top, and then you're going to ride the whole thing down, right? This is arguably the greatest indicator of all time. I know, right? So in 2008, it was a great indicator. In 2001, it was a great indicator, and it helped you short the entire market, right? So what happens here? Now it kind of jumps out again. Let me find my mouse. It jumps out again here, and then pulls back really hard. Now, and it basically goes green here, right? So I know what you're thinking. What happened? Maybe it's the fact that it's much smaller, right? It's significantly smaller than these other two. Maybe that's the reason, right? And we still have this event over here that's unexplained. What's that? And what's this? And then we have another one here, right? What is that one where it pulls back in? We have these two market pullbacks, but if you short on these market pullbacks, right, you're basically shorting, here, and you're shorting, maybe up here. And you may be catching a little bit more of a downdraft on this one, but what happened? Now, I began paying attention to the markets in about early 2012, late 2011. Really, once again, when I say paying attention to, I mean paying attention to the financial world in any meaningful way. My knowledge was a joke. I would say, I've really begun to put together my understanding of the market in a way that I can't even begin to imagine. But that only began to occur in late 2012. Early 2012 and 2011, I had no idea what was going on. But from what I understand, right, this period right here, quantitative easing number 2 had ended. And that's why people had panicked. Now, I started paying attention to the market, like actually paying attention to it, like trading my first stock and knowing what was even going on in the most idiotic and retarded sense. Basically about here, right? And I didn't experience any of this crash here. I didn't experience any of that panic that a lot of investors had experienced, right? The stocks were at lows, and I managed to pick some awesome stocks. I picked, BDSI, CRM, a whole bunch of others that were actually really good picks. BDSI made like 300%, CRM made like 50%. And my first stock I ever traded was the BVSN bubble, and then later the sync bubble. Those were pretty awesome, but I stopped paying attention to stocks after that. Got more interested in forex and securities. So now what we're going to look at here, I'm going to pull this back a little bit. Now the first thing I thought was it must be technicals. For anybody who knows market technicals, and I may make a video explaining them later, you're looking at the 2006 pullback. You're looking at this first odd moment as a, what the fuck happened there, right? Why did that happen? And maybe you're thinking market technicals. I thought to myself, well, look, if this was QE, right? Maybe I should go back and look at the QE policy of the Fed. And, well, I mean, I don't need to. I already know it. QE1, I believe, ended here. QE2, I believe, ended here. And we basically transitioned from like a temporary version of QE. They called it like some kind of like extend or something like that. I forget what it was, QE extended or something stupid like that. And they were still doing the bond purchases, but it was basically another version of QE, but they didn't call it that. Long story short, we transitioned from that right into QE3, or, well, it was now called QE4, and a lot of people call it QE4 ever. Now, QE was discussed as a tapering event, but that never really took shape, and now there's speculation stepping out that QE may actually increase. Okay, well, now the interesting part comes. So, if this indicator says go short, okay, and this indicator says go short, and this indicator says go short, that one says go short, and this one says go short, all right? But this one works, this one doesn't, this one, does, this one doesn't, and this one doesn't. But we know that 2 of the 3 that did not work were caused because QE was ended. What? Yeah, I gotta go to this thing. We gotta go see this fucking movie, and I gotta go get drunk. So in the last 2 minutes, I'm about to blow your mind. Japan started its own version of quantitative easing, the original version of quantitative easing, in 2001. Really 2000. And they were the first people to start QE. They did the first experiment. Their bond market was fucked way before ours was. And it is still fucked. And fucked is the correct terminology. So in 2001, they began QE. Now, guess when it ended? If you guessed early to mid 2006, you guessed right. Now, I'm going to make a part 2 to this video. If you guys are interested, I've done more reading, a little bit more research, and the rabbit hole only goes deeper. So, take it easy.